Hi, everyone. It's Brad Thomas, and welcome back to the Wide Moat Show. I'm joined today with my co-host, Nicholas Ward. Nick, it's good to see you today.
Hey, thanks, Brad. You guys just missed Brad give a rap freestyle behind the scenes. So the vibe for this video is probably going to be exciting, and the vibe should be exciting. The S&P 500 is back into positive territory on a year-to-date basis because of the rally we're seeing today. So wearing green for money, and I think I'm going to keep the beard, Brad. This is my playoff beard. Until this rally ends, I'll keep growing this thing out.
That sounds good. I think our viewers will definitely like to see that, Nick. And yeah, as far as the wrapping goes, that's just for our primary customers here. I can't give away my wraps to the free audience here, but maybe one of these days I might be tempted to do some REIT wrap. So today we're going to talk about a really interesting topic, and of course, this is a topic, Nick, you and I have talked about quite a bit here on our previous shows, which is avoiding some of the bad companies that we won't invest in. We spend a lot of time talking about companies we like, we want to buy, we want to recommend, but it's equally as important to provide a fair share of time to those stocks to avoid and why we're going to avoid them. And so today we're going to be talking about value traps. For those of you who don't know, a value trap is when a stock looks really cheap based on its price, but it turns out to be a bad investment. It's almost like an illusion in a desert oasis, like when an investor buys a company believing he's getting such a great bargain, but it turns out to be an absolute lemon. And so that's what we want to really talk about today, is how we're going to avoid these lemons. Nobody wants to end up owning a lemon.
Yeah, no, I guess just sticking with that oasis metaphor, your money could disappear, right? And people, we paid much more. Losses affect most humans more than wins. We take our wins for granted. We kind of latch onto our losses. So I think a lot of the reason that people, will say the stock market's rigged or you can't make money in the market, average investors are doomed to fail. It's mainly because they hold on to their losers. So I think avoiding those and kind of, just avoiding those pitfalls and not falling into those kind of sadistic, nihilistic mental traps is a good idea. So that's what we're here to do today.
Great. Well, this past weekend I celebrated a birthday. I'm not going to tell you how old I am, but I had a birthday, which means the good thing about having a birthday means I've got more experience in investing. And when I was thinking about this show today, this value trap show, I thought back about a company I used to build for. This right here is a shopping center. I built one of my first shopping centers. Is nothing really impressive, but it has a Blockbuster Video. And I used to build stores for Blockbuster Video back in the 90s. At the time, they were really accelerating their business. But of course, in 1998, this little known company called Netflix came about. And they started this subscription-based model. And ultimately, that led to really the disruption of Blockbuster Video. At the time, Netflix had just about $50 million in terms of their value in 2000. And today it's about 302 million subscribers with Netflix and a market capitalization of $470 billion. I'm going to put a price chart here on the screen so you can see this huge disruptor with Blockbuster and what caused Blockbuster to go away. And of course, I quit building stores for Blockbuster. But that's a prime example of a value trap. And a company like Netflix came along, just totally disrupted the whole video space. And of course, now you can see what's happening with Netflix.
Yeah, you talk about birthdays. They're making me feel old now, Brad. Blockbuster used to be like the place to go. You get a bag of chips, some candy, rent your favorite N64 game, and have a pizza that night with your sleepover. That was my childhood, and now they're all gone, like you said, because of disruption. And so, yeah, I think disruption, when we're talking about individual companies and even entire industries, is going to be one of the major things that everybody needs to be on the lookout for. It needs to be thinking about when we're, talking about value traps, because if a company seems cheap, and even if it looks fundamentally cheap at the moment, if those earnings are just going to fall off a cliff in the next 1, 2, 5 years, then all of a sudden that's where you're falling into this trap, and that's where you're bound to lose, a lot of money.
Yeah. Another example that reminds me, and again, showing my age again, but everyone remembers Kodak. In 1996, Kodak was valued at $31 billion. And we all know how that story ended, with the digitization of the camera space. And of course, Kodak could have jumped on that train and possibly would have been a very well-known brand today. But we all know what happened. They did not embrace innovation. and they ultimately filed bankruptcy and went by the wayside.
Yeah, I don't know if there's anything Kodak could have done, right? I mean, I think even Nikon still makes cameras, Sony does. There's still some camera makers out there, but everybody's got a really good camera in the pocket of their pants or their jacket, in their smartphone. So I think, that was inevitable, I think, and just unfortunate for them. And, I guess Tim Cook's out there making the best cameras in the world. So you can't, I don't know if I blame Kodak so much as I do, just technology taking over on that deal.
Yeah. So again, starting we look at earnings, we look at innovation. Another thing that's really important at Wide Moat Research, and we spend a lot of time analyzing, is the strength of the balance sheet. Now, I know that's a boring topic to discuss, but we found over time that companies with enhanced leverage, with too much leverage, ultimately end up becoming value traps. And that's because they can't raise capital. That's because they can't, ultimately, they cut the dividends at some time. They can't capitalize on M&A opportunities when they come along. So there's a lot of things to consider when analyzing these companies. And we always find that companies that are value traps, we're going to talk about a few here just in a minute, typically have high leverage. And that's really an important thing to look at. One classic example of that, I think that comes to mind, is a company that I'm going to talk about here in just a minute. So I'll save that till my pick. And the last thing I want to touch on real quick before we get to the picks is management. Now, of course, we always consider management, because when I talked about the earnings, I talked about innovation, I talked about the balance sheet, but management is really connects all of those dots, fundamentals, innovation, balance sheet. Poor leadership can become a primary reason for poor returns. There's a book that I just finished reading a new book. This is a book I point to it a lot, called Winning Investors Over. And I would definitely recommend this book to anyone today. And I want to read something that I found was really interesting in this book. Of course, I've got to get my glasses. Again, I'm getting older. The capital markets arena is where the success or failure of public companies is largely determined. The company's cost of capital, the all-important price, and often the availability of external funds to finance investment and growth is determined in the capital markets based on the information available to investors. Share prices, the outcome of investors' expectation and trades, directly affect managers' compensation and increasingly their tenure. Research consistently shows the poor share performance significantly increases the likelihood of top management termination. So again, when you have these management teams that don't embrace innovation, they don't embrace growing the cash flow of the company, and they don't embrace the balance sheet, utilizing the cost of capital advantage of the balance sheet, then ultimately those companies underperform. And it's the management's job to use those levers to enhance and increase shareholder value.
Yeah, it's funny you mentioned balance sheet analysis as being boring. People probably hate it when we talk about A ratings, B ratings, et cetera. But you nailed it. That is so key to growth. You can't do M&A without a great balance sheet, and that is where so much of the growth comes from in the S&P 500. I looked down while Brad was talking. There's this stat you hear going around. I wanted to get it right. It says roughly 75% of the S&P 500 won't be around in 5 years or something. That's what like McKinsey believes. And that's not because these companies are going to disappear. It's just because they're going to be taken out. They're going to be bought by bigger, stronger companies. Big dogs always win the fight when it comes to balance sheets. And alluding to the quote in Brad's book, if you don't have money, you can't pay top talent. And that is so important. Last week, we talked about Warren Buffett. Warren Buffett always says he wants to get the best leaders into those companies. And because ultimately, when you're a shareholder, what you're doing is you're entrusting your capital, your hard-earned money to the leaders of the public companies that you invest in. The best people aren't going to work for free. They're not going to work for a little bit. They're going to cost a lot of money. People kind of complain about CEO compensation, but at the end of the day, they're the people that are making the biggest, hardest decisions that create wealth for shareholders. So I don't necessarily like to see the big wealth gaps and some of these statistics we see with CEOs making, so much more than the average worker. But when I own shares of a company, I want to know I got the best guy in there or lady in there making decisions for that company.
Everyone's heard the saying, Warren Buffett said it, price is what you pay and value is what you get. So you always have to look behind the price tag of the business and focus on these critical factors that we just discussed. So let's dive into, first, we thought we'd start out with a value trap on my side. Nick will talk about his value trap, and then we'll talk about some value investments. Nick's got one, and I've got one. Companies that we like that are not value traps, and then we've got one that Nick and I basically agree on. We're not sure if it's a value trap or a value investment or somewhere in the middle.
Yeah, and that's the key, right? This is a lot of science into this. We got to look at the numbers. The numbers dictate, 95% of what we do at Wide Moat Research, but there is a bit of an art to this too, because neither Brad nor I nor anybody can see into the future. And what we're going to talk so much about right here is future growth prospects, and that does, have a degree of speculation involved. So that's important to note, and that's why it's so important to have kind of trusted analysts on your side when you're thinking about the difference between a value and a value trap, because nobody truly knows without the benefit of hindsight.
For sure. Now, let's get started. My first value trap stock is a company that's really in my wheelhouse of real estate investment trust. That's REITs. And by the way, any of you watching today, if you comment on the stream below, I'm going to give everyone a copy, the first to comment.
And not everyone. That's a lot of books.
Not everyone. I'd love to give everyone, but you tune in every week, you'll get one. But REITs for Dummies, I published this book last year. So if you want to know all about REITs, and we talk about REITs a lot on our show, you can learn more. So please comment below and subscribe to our channel. That means a lot to us. Now, my first pick is Global Net Lease. And I wouldn't actually call it a pick because I'm not like picking to buy it. I'm picking to avoid it. It's Global Net Lease. The ticker symbol is GNL. Now, I just talked about leverage. This company has high leverage compared to its peers. It's about 55% levered. That's net debt to gross asset value. That's one problem. The other problem is management. And I want to give management a little credit here. Okay. Credit when credit's due. They launched the company as an externally managed REIT, which I have a big problem with. Now, they more recently have internalized their management. However, a picture tells 1,000 words. I'm going to put this chart up. Actually, this is a fast graph we're going to use here. And you can see I've highlighted on this chart, there are about a lot of X's on this chart. That means every single year since going back to 2017, except for 1 year, starting from 2017 till today, they've only generated positive earnings in one of those years. Every single year, that's why I've got the X, they have negative earnings. Talk about fundamentals. I mean, I think my youngest daughter, who's going to finish high school in about 2 weeks, she is graduating. She's going to college, Coastal Carolina. She can understand this chart. When you have a company that has declining profits or earnings, and a chronic history of dividend cuts, that's a telltale sign that something is not wrong. And this could be a lemon. And of course, we call this company out many times before because of this sucker yield. Remember the sucker yield series we had? But this is beyond a sucker yield. It is a value trap you should avoid. Now, shares are trading at about 6.7 times today. Normally, they trade at about 8.5 times. But again, I don't care how cheap the company is, how high that dividend yield is, poor management, high leverage, poor earnings history, innovation. I don't see anything whatsoever here. So I'm definitely going to put Global Net Lease in the value trap bucket for today. Nick?
Yeah, Brad, this isn't to take anything away from your daughter. She's obviously a very intelligent young lady that made it into Coastal Carolina. I think my 5-year-old might be able to look at this chart and see that this is not a good company, right? The red numbers, everybody knows those aren't good. It amazes me that people want to invest in stocks like this. And I know why they do. It's that 9.5% dividend yield you see in the top right-hand corner. They see that and they just assume it's safe, maybe you're struggling. You didn't save enough for retirement as maybe you should have, and you need to reach for yield. I get it, but the dividend's falling every year. So your yield on cost is going to fall as that dividend falls. As the share price goes, you can't rebuy anything else. I know, what's the market cap here? 1.7 billion. So a lot of people own these shares, right? I'm not sure why, but, just please don't fall into these traps, right? This is a value trap, and I think it's because of chasing yield. So it's kind of a yield trap too, right? Remember, if the dividend is not safe, it's not worth a darn, right? And if it's not growing, honestly, it's probably not even worth that much because every year inflation's moving higher. So we don't want to just own safe dividends. We want to own companies with growing dividends so that your purchasing power does not get eroded away by inflation. So I don't cover this company, Brad. I just pulled up the chart for the first time. Now I know why I don't cover it, because it doesn't pass any of the screens I'm looking for. And I certainly agree. I hate that, nothing against the management team. Maybe they have a great turnaround plan, right? But it's not a stock that I would own personally. And I would say, I would beware of a value trap here.
For sure. Well, Nick, I know your next pick is really an interesting space. I'll let you touch on it. And it's definitely got a lot of volatility. So I'm excited to hear about it.
Yeah, I got two, because like you said, this is one is just a small cap, and it's Tilray. It's a tobacco company. It wasn't that long ago before. Sorry, it's a cannabis company. It wasn't that long ago before all of these marijuana companies were super popular, because everybody thought, Altria and Philip Morris, all these big tobacco names were going to move into the weed space, and that was going to give them growth and yada, yada, yada. None of that happened, right? Marijuana is still illegal on a federal basis in the United States. Sure, on a state-to-state basis, that changes. But people have been so hyped on all these companies, and this one's worth 46 cents a share now. And because of the very cheap share price, people always talk about, is now the time to buy, right? I mean, I can buy 100 shares for a little bit of nothing. And if this, wasn't in 2019, these were worth $70 a share, right? So if you happen to do that, all of a sudden you've turned, a couple $100 into a life-changing amount of money. But very similar to Brad's story, if you look at the bottom here, they haven't produced profit ever. It's been negative earnings per share every single year since they become public. It fluctuates. It goes up and down. So you don't always see those red numbers. It's not going down every single year, but it's in the negative territory the whole time. And that's certainly not what we want to see, right? So if a company can't consistently generate profits, I would lean towards value trap, because I don't know what you're going to get where you're going to determine the value off of. Value, like Warren Buffett said, price is what you pay. This is worth 46 cents a share. Value is what you get, which is the earnings on the multiple. Well, this doesn't have an earnings multiple because it doesn't make money. And I don't want to spend too much time on this, because this isn't the type of thing we recommend at Wide Moat. This is just the type of thing that when people hear I work in finance, they always ask me about these types of stocks. They want to buy 10,000 shares and get rich quick. Well, get rich quick schemes never work. So, just please don't fall into those types of things. So I do want to mention a very large company, $131 billion market cap, Pfizer. Everybody knows this company, a pharma company. They've been around for decades. They've sold off massively. And because of that, they're at like a multi-decade low P/E ratio. Their dividend yield is 7.5%. I will say, I think the dividend's safe. So if you really like yields, maybe this is a yield that I would much rather do this 7.5% than Global Net Lease's 9.5%. I don't think there's at risk of a dividend cut. I don't think you're going to get much growth here. But Pfizer, looking at the fast graph below, you'll see they don't have forward growth prospects. So yes, the multiple is very low, historically low, but it doesn't matter if they can't turn things around from a fundamental standpoint. They're struggling with vaccines. Their pipeline is so hard to understand. There's kind of macro concerns with drug pricing and all that stuff that we're seeing in the news these days. So yes, this stock looks cheap. Who knows? Maybe it goes back up. Its long-term P/E ratio is about 12 times. Today it's trading for 7.5. So if you did see mean reversion back up to 12 times, I mean, you're talking about 40, 50% upside in the near term. But I don't know what's going to be the catalyst for that, right? If the company's not growing earnings, what's going to change the sentiment? So, people talk about this too, right? I would much rather invest in a company with growth than a beaten down company like Pfizer. If I needed 7.5% dividend yield, maybe I'd think about it. But, I'd much prefer to get a company growing than a stagnant name like this.
Great. Thank you for that, Nick. Now I'm going to switch over to a company that's really the exact opposite of Global Net Lease, which I just talked about, in the same sector, in the same industry. And I know I talk about this company quite a bit on the show, but it is a textbook example of a value investment and not a value trap. And that is Realty Income, ticker symbol O. Now I'm going to show up another chart now to compare to GNL. As you can see, Realty Income has no X's on this fast graph. Everything up there is check, check, check. So going back to 2017, I wanted to compare apples to apples with Global Net Lease. You can see in every single year, the company has increased earnings. In fact, if I were to show another chart, I could go back to since the company was founded over 30 years ago, and there was only 1 year that the company had negative earnings out of 30 years. And of course, the company also, unlike Global Net Lease, which has been a chronic dividend cutter, Realty Income has increased its dividend every single year for 30 years in a row. Why is that? And how is that? Why is that different from the other pick? So the answer is Realty Income has an A-rated balance sheet. Again, we spend a lot of time analyzing balance sheet. They have very low leverage compared to their peers, but also just compared to the industry in general. And you combine that credit rating with the company's diversification, the power of scale, they're able to continue to consolidate and move more into the M&A space. They've completed 2 large-scale M&A acquisitions in the last 5 years. They had one that happened during COVID. They had one happen after COVID. One was Spirit Realty. The other was VEREIT. So they've been able to continue to acquire companies and consolidate this very fragmented marketplace. So while Realty Income has taken advantage of this fragmentation and their cost of capital, their balance sheet, and they have an excellent management team. I'm actually going to interview the CEO next week when I'm at the ICSC conference in Las Vegas, where we'll be interviewing about a dozen different CEOs. This company, as you can see, is a value investment. They are trading at a significant discount. You can see shares are trading at 13.3 times compared to their normal value of 17.9 times. But there is no question about it. This is not a value trap. This company has plenty of value, is cheap. And again, the fundamentals speak for themselves. So like to always say, follow the money. I think that's what, I forget, Tom Cruise said. I forget the show, but follow the money is really what it's all about. Focus on these fundamentals, the balance sheet, the earnings history, management. And by the way, this company also has some pretty cool innovation. I mean, they use technology to source their assets. They use artificial intelligence to scan over their leases. There's a lot of technology that they've applied to this business model so they don't get left behind like a Blockbuster Video, for example. So definitely like this company a lot. And Nick, I'm excited to hear about your next pick, which again is the opposite of the value trap.
Yeah, and like you said, it's not like Global Net Lease doesn't. They wish they could do the same things as Realty Income. They wish they could do these big, large M&A transactions. They wish they could buy the same building for the same price, but you can't. If you don't have a good credit rating, you can't pull those deals off, or at least not in a very profitable way. So this is an example of the rich getting richer. Having that very low cost of capital just enables a company like Realty Income to make deals that its competitors can't. So that's you don't have to reinvent the wheel here, right? Just oftentimes just buy the best companies in a given industry and take advantage of their competitive advantages. Moving to my value, it's a company I've talked about a little bit. I scanned. There's not that many names trading at 52-week lows anymore. The market's up, 20% off the lows, but PepsiCo still is, ticker symbol PEP. Why? I think probably GLP-1 drugs. Honestly, that is a headwind. But human beings aren't going to stop eating, nor are they going to stop drinking. And as you can see on the fast graph below, 2025 is expected to be a down year. Even great companies have down years periodically when it comes to earnings growth. But looking forward, you see that 6% expected growth in 2026 and 2027, which is in line with the company's long-term average, right? This isn't a name that generates 10, 15% growth very often. It's also not a company that goes negative very often. They're pretty, between 4 and 7% earnings growth a year. They yield 4.3% right now, very well covered. As you can see, earnings are expected to be about $8 this year. The dividend's at $5.60. So plenty of margin of safety there. They just increased the dividend by 5%. So if you add in 5% earnings growth on top of a 4% yield, you're already at 9% annualized returns, which is basically, I think, what most people want. But you'll see on this chart, the blue line represents Pepsi's long-term average PDE ratio. That's roughly 20 times. Today, they're trading at 16 times. So if they traded from 16 up to 20, that's where you get the massive gains. That's where you get 30, 40% returns on a very boring company like this. So is Pepsi exciting? No. Is it something I want to invest in at 22 to 25 times earnings? No, it's not. It's only growing at 5% a year. Is it something I like at 16 times? Well below the S&P 500's multiple, which is about 21, 22 times right now, and well below its long-term average? Yes, because I don't think Pepsi's future fundamental performance is going to be that different from its past, or at least its recent past. This is a very mature company. And like Brad said, it's got an A+ rated balance sheet. So if they need to go buy a healthy popcorn brand, or if they need to go buy some soy milk or, whatever it is that people are drinking, they can do it. They can do it without having to cut the dividend, without having to raise a lot of debt, without having to hurt their credit score. So I love companies like this that can just make changes when they need to address their growth concerns and quickly get back on track.
Great. Well, finally, we're going to wrap this up with the last pick. And is the company a value trap or a value investment? And this is a company Nick and I have both covered quite a bit here at Wide Moat Research. And that company's Rexford Industrial, ticker REXR. I get this question a lot about Rexford. Rexford is an industrial REIT, which means they own warehouses, primarily, in fact, exclusively on the West Coast. They're a pure play West Coast warehouse.
Well, it's not even West Coast, right? This company is exclusively in the Southern California, basically the Orange County, the Los Angeles infill market. So infill, for those of you who don't know, is if you're driving around a city and you see a big vacant lot or an underutilized lot, that's what infill property is. And this company basically just buys all the infill lots in Los Angeles and then turns them into warehouses. They've been doing that for years, and it's worked out well for them.
Yeah. And look, based on fundamentals, and we look at the company's history, and Nick, I assume you'll put a fast graphs up here. The company has generated fairly good earnings, double digit, in fact, through most years, going back again all the way to 2017, maybe 1 year going into COVID. But more recently, they've moderated that growth due to primarily tariffs and the tariffs risks. But shares arguably are really cheap right now based upon the current multiple. The dividend yield's about 4.8%, and the multiple is about 18 times compared to kind of the historic multiple of about 38 or 39 times. So, again, is Nick, in your opinion, is this company a value trap or a value investment?
Well, I'm going to be honest, I don't know, right? And that's where it's so hard with a name like this. Historically, you can see this company has outperformed its peers and the broader markets in terms of earnings growth and total return. So if you own this stock from 2013 to 2021, you're probably a millionaire. It's made so much money. It was trading for 55 times in late 2022. I mean, this was like the only REIT with that type of multiple, but it's because any trade between US and Asia, this company benefits from. It all comes through the Port of Los Angeles, Port of Long Beach. And, most of that stuff goes to their properties. The problem is I don't know what that trade relationship is going to look like. President Trump just, they signed that 90-day pause with China yesterday, or I don't even know if they signed it. They came to an agreement. I don't know what happened in that room, but prior to that, there was basically an embargo between the U.S. and China. We saw container ship volumes fall off drastically. I think they were down like 45% year over year in April. If that was to continue, I mean, not only, we're talking about empty shelves across the country, we're certainly talking about empty shelves in Rexford's warehouses. So if they're not, struggling to find tenants there, that's tough. So as Brad said, you can see a massive gap here between the current valuation and the long-term average. I don't expect to see Rexford trading for 33 times, anytime soon. You would need to see a huge trade agreement between the US and China, and I'm not expecting to see that. But even if this company just went up to 20, 22 times, 25 times, you're talking about 40, 50% gains in the near term, and it would be an absolute home run. My problem is I don't know if that's going to happen, and the downside is massive, right? Because it still trades for 18 times. So some of these other REITs trade for 10 to 12 times if they're experiencing a lot of trouble. So if the earnings fall off and the multiple continues to compress, there could be another 30, 40% downside here. So those aren't the types of, risk rewards I like. I love the upside potential, but I don't want to risk the downside potential. I had owned these shares for years. I actually sold them earlier this year, kind of when the trade war stuff was just getting started, because it was just too much uncertainty for me. But the dividend safe, this is just really interesting company. This is the type of thing Brad and I are talking about. I don't know what the right answer is here. Maybe you see this company, you buy it today, you're up 200% in 5 years. Who knows? But, you could be down 25%.
Well, I'm going to go lean towards the value investment, not the value trap. Shares were trading during COVID, at the depths of COVID, at 36 times. So now we're 50% below that.
I mean, this is the cheapest I think the company's ever been, right? Yeah. So this isn't just a 2025 discount. This is an historic discount since the IPO of Rexford that we're looking at.
And again, probably the strongest balance sheet they've ever had. I mean, they're triple B plus rated, and they have only 23% long-term debt to capital. So I guess from the balance sheet perspective, and again, look at analyst estimates. They're not great, 6% in 2026, 10% 2027, but that's growth. And so I would believe this company again. And by the way, just Wide Moat Daily, check it out. For those of you who don't read our daily free research, please visit Wide Moat Research. And I just wrote on China today, so that those articles come out every day at 5 o'clock. But I just can't believe this company's going to zero. During COVID, when the shopping centers, REITs and shopping center landlords sold off massively, I reminded the audience, these shares aren't going to zero. I mean, they're being priced as if they're going out of business. I just cannot believe, with all of these assets that Rexford has in Southern California, that this is going to go to a zero or some ridiculously cheap number where it is right now. I just cannot believe it. I think there's plenty of margin of safety. I don't think it's a margin of stupidity. I think it's a margin of safety. So I think this is a good pick right now. Now, obviously, I want to end on one thing, which I think is critical to always talk about towards the end of our shows if we can. And these are the rules of risk mitigation. 3 quick rules: always diversify. So yeah, I like Rexford, but don't put all those eggs in one basket. Now, I always like to tell people about the 5% rule. Try to put 5%, no more than 5% in any one stock. That's a great way to avoid these potential value traps. The second thing I like to remind folks is to always start with a smaller amount of money. Then you can dollar cost average at some later time. So maybe you want to, think about tranches to add capital like Rexford or any of these picks that you like or that we recommend. Make smaller bets and build your portfolio out over time. So don't put all of your eggs in one basket to start with. And again, keep them at 5%. The last thing I want to talk about is you have to have confidence in your picks. Do your due diligence. I'm glad you're watching this show. Hopefully this is giving you some confidence in terms of how to invest, but make sure you do your own due diligence. And of course, we have a terrific product for that here at Wide Moat Research. Nick and I write a monthly newsletter, and we just came out with some picks here recently, Nick, and I think you want to touch on that real quickly.
Yeah, no, we're excited about those picks, and I think more than those, I don't want to give them away. So yeah, we think they're going to do great, and if you want to see what they are, there was 4 of them, so you can sign up for that newsletter. Check those out. Getting back to your 5% and your diversification and your dollar cost averaging, what that all those things do is they fight against greed, right? A lot of people, they want to go all in, they want to go all right now, they want to make money right now. That rarely happens in the stock market. And the easiest way to kind of mitigate that risk is, I think, to have single stock risk ways to kind of settle that and to stop that from happening, which is asset allocation. And I love the dollar cost averaging point that you brought up. I never go all in at once. Even if I think it's a home run, it's not worth the risk to me. One, because if it goes down and I don't have any money left, I'm going to feel terrible. And I know that. So how can I avoid that? I can make sure I buy half a position now. Then I buy another 25% if it falls, another 10%, and then another 25% on the way down. And the good news there is if I buy a half position and it rallies, if Brad's right about Rexford and those fundamentals hold in steady, the analysts are calling for massive growth right now. If that happens, this is going to be a home run. I think that's for certain. Then I still make a ton of money, right? If you buy these shares here and it goes up, there's nothing wrong with making, less money than you could have. You're not leaving chips on the table. There's always going to be other investments to make. But if the stock does fall, if kind of my fears are proven correctly and those fundamentals deteriorate further, then you're going to want to have some extra kind of dry powder to play with. So I think that's the main thing. And it's one of the major mistakes I see people make is they get an idea, maybe they research it, they spend 10 hours, they feel great and they go all in. Well, you got to be right. And nobody knows what the future is going to hold. So, dollar cost averaging is probably your best friend as a long-term investor.
Great. Well, thank you, Nick. And thank you everyone for joining us today for our Wide Moat Show. And we'll look back to see you next week. And again, please subscribe below. If you haven't, drop us a comment. I will be sending out 1 book every week to anybody who comments, 1 person who comments per week. Thank you. And Nick, thank you for joining me today. It's been great. And I've learned a lot about value traps and hope you have too.
Yeah, no, I always love watching these videos, watching the replays, picking up some knowledge. And I certainly hope that's helping our subscriber base. And the last thing I'll say, I think Brad and I want to talk about an individual stock next week. We'll obviously, between the two of us, we'll talk about it. But if you guys have suggestions on a company that you'd like to know more about, please leave that in the comment section below. And we will strongly consider, analyzing that company for you guys. So thank you guys. Have a great week. And we'll see you next Thursday.
Thank you for watching the Wide Moat Show. Don't forget to like, subscribe, and comment below. Also, please subscribe to the WideMoatDaily.com. I'll be sending out one free copy of my REIT for Dummies book every single week for those who comment below. Only one per week. Thank you for watching and being part of the Wide Moat Show community.